We are certainly less restrictive. This has been quite already a long succession of rate cuts that we are implementing. We do think that the journey is very clear, although these rate cuts implemented, because the European economy is stagnated. We do have in our baseline a projection of inflation going to 2% in the medium term, but that includes further adjustment in the rates. But we need to remain open and data dependent and deciding meeting by meeting. And this is even more so in the current juncture with all this uncertainty that is out there in terms of economic policy measures.
Indeed, there are a lot of moving pieces, and you and I were having a discussion late last year about whether 50 basis points would be required. Since then, a lot of news flow from the European side on defence spending from the Germans, but still with a question mark around tariffs. How high is the hurdle to another rate cut in April? And if we did see tariffs come into force, would that reinforce the notion that a rate cut again is necessary?
Well, we defeated inflation while retaining financial stability, and that is our main purpose at the ECB. Europe as a whole, and you mentioned these defense and infrastructure expenditures, Europe must move forward, but it also must be a beacon of hope for stability in the world. And we at the ECB, we need to play our part. And I think we have been doing that with great success. So the decision in April will take on board all the information we will get until then. Tariffs are a tax. They are a tax on both consumption and production. And we do know that taxes have a very clear impact on the economy. No one will end up gaining from a tariffs war, and the decisions that we will continue to make over the course of our meetings will take on board all this information. I am very concerned about the European economy. We revised downwards again the projection for GDP. This was based on a lower level of exports and investment. Especially investment has been quite subdued in Europe. It will take 4 years for us to go back to the 2023 level of investment in the private sector. 6 years in terms of housing investment, going back to 2022 levels only. In 2028, right. These are numbers that raise some questions about the recovery in Europe.
Right. What is so confusing here is the short, the medium, and the long term. Because short term, we are still seeing this weakness in European growth, and even reinforced by the industrial orders out of Germany this morning. All that with the potential tariff threat. So that is the short-term picture. But more medium-long-term, we're talking about now this fiscal package that you're having to somehow put into your numbers from Europe. How do you think about these moving factors and just how interventionist the ECB may have to be here in terms of smoothing out the cycle?
If these packages, these counter-cyclical packages, are well designed, they will have a positive impact. Because economic activity in Europe, it's running below potential. We have a negative output gap. So we need some stimulus coming from both an easing in the financial conditions and also from some support to investment. And those packages, again, if they are well designed, they will can prove effective in helping the European economy moving forward. That's what we need to be ready to prepare, to implement, and to see, again, this great European economy moving forward. We have a very strong labor market. most of the resilience of the European economy is sustained by a very strong labor market. We will be discussing that this afternoon in Portugal, here in a conference that the Bank of Portugal is organizing. And it is quite important for us to make sure that this resilience coming from the labor market is sustained, because if that is not the case, we may be facing economic and social difficulties in Europe of a scale that we don't have, luckily, today.